Hello, fellow Rebel Capitals. Hope you're well. So we have got China is absolutely in crisis mode right now. I mean, as Americans, and most of you are kind of in English-speaking countries, we kind of get hyper-focused on what the Fed's doing or what's happening in Europe, maybe Canada, maybe Australia. But we have to remember that the second largest economy on the planet Earth is China. And what is happening in China definitely matters, not just for the global economy, but more specifically for the US economy. So, first and foremost, let's look at the details as to what's actually happening. And when I say they're in crisis mode, I'm not exaggerating. Let's just go right over to CNBC and check this out. China's economy is going through a slow, painful, grinding adjustment. And I think that's putting it mildly. If you guys saw the thumbnail, that was an actual chart of the 10-year Chinese government bond. And you'll notice that the yield is way lower now, not just the same as the GFC, it's lower, way lower. In fact, it's lower than COVID. So if we are to believe that interest rates long into the curve or long-term interest rates are an indication of growth and inflation expectation, what is that telling you about the Chinese economy if the 10-year treasury yield is 40 basis points less than it was during the cerveza sickness? And oh, by the way, they're trying to prop it up as far as the yield. More on that in just a moment. Key talking points. Following a slew of data released over the weekend from China that paint, and by the way, if you know they're lying about it, and they're giving you the data, but if anything, they're painting a much rosier picture than reality. Let's just keep that in mind. Following a slew of data released over the weekend from China that painted a fairly bleak outlook for its economy, economists have tapered their expectations for the country's full-year GDP growth. And by the way, they're in deflation right now. In fact, I didn't pull that up, but I should pull that up. Let me, Josh, can you pull up an article, please, of the Chinese inflation numbers, and so we can look at their. I know one metric they use is actually showing negative inflation. In other words, actual deflation. So I don't know how, in an economy that's a debt-based economy, how you can have outright deflation and yet you don't have a recession or something worse. But
their inflation rate it's like 0.6%.
Yeah, but they're like core PCE. There's something, one of the metrics they use over there, Josh, is negative. It was like negative 1 point. We did a video on it the other day. But so you're saying their headline, the equivalent of their headline CPI is 0.6?
Yeah.
Okay. Yeah, keep digging around a little bit. So, professor of international trade and economics at Cornell warned that Beijing's economy outlook for the second half of the year is now flashing red or pretty close to red. There hasn't been much good news in the latest round of data, and this has been the pattern for the last few months. And this is the same gentleman talking to CNBC about the long-term issues related to the property prices and so on. So they're, at the very least, they're in a balance sheet recession, which is where the assets that people hold are going down in value. And I would argue they're not going down just a little bit, they're going down a lot. You can imagine what would happen to the United States, to the actual real economy, if the financial economy was doing as poorly as China. Because, Josh, another thing that you can pull up is, we all know their housing prices have been collapsing, but look at what their stock market has been doing. Pull up a chart of that, please. So getting back to the article here, long-term issues with property prices, short-term issues with domestic demand, especially private investment, household consumption. So again, your private investment down, consumption down, domestic demand down, asset prices down. I don't know how you can, how you could avoid a recession. And then, of course, the bigger question becomes, do they have the capability, because of the second largest economy, to pull the whole world into recession, or at least make things worse than they otherwise would have been in, let's say, the US domestic economy. Getting back to CNBC, Duncan Wrigley, chief strategist at Everbright Securities, told CNBC positive side, you could say, given the size of the big housing downturn, what China hasn't seen, say, compared to with many other subprime and Japan's big housing turn, you haven't seen a systemic financial crisis in China. We haven't seen it yet, but it doesn't mean that you won't see it. And again, if their 10-year treasury was not basically 2%, I'd be saying, okay, yeah, maybe you're right. Maybe they've had this massive balance sheet recession. In other words, their property price, the asset prices have come down by whatever, 50%, and they can avoid it. But the bond market is telling you that they can't avoid it. That's what the signal is there. And again, we're going to check out a chart here as soon as we get done with this article. So to some extent, Chinese government has managed to insulate, well, so far. But again, we're completely ignoring all the other signals that we're getting. Data released Saturday showed retail sales, industrial production, and urban investment grew slower than expected, so they're missing expectations. While year-on-year home prices fell at their fastest pace in 9 years. The figures were the latest in a series of disappointments for the world's second largest economy, which has experienced a lackluster, that's putting it mildly, since the cerveza sickness. With U.S. Fed expected to drop, chief Greater China economist, head of Asia economics at B of A, that the People's Bank of China will likely not be cutting as much as their American counterpart. Yeah, I mean, it's interesting, isn't it, that we call China a communist economy or communist country, implying that they don't have capitalism, but in ways, not in all of it, but in ways, China, you could argue they have a more free market system than we do. In other words, they're saying, hey, if these entities are going to go bust, they're going to go bust. They shouldn't have taken out that leverage. They shouldn't have invested in building those 45,000 apartment complexes and all these ghost towns. I think we could learn a lot from China just letting things be, although they're not doing that completely. Not doing that completely because they're actually intervening in the bond market because they don't like the message that it's sending. But again, we're going to get to that. Actually, let's shoot over there. I find it very ironic that CNBC is saying breaking news and updates on Telegram. But that's a completely separate video. You guys know where I'm going with that. All right, so now let's look at the Chinese 10-year. And this is what we use for the thumbnail. And this is telling us that future growth and expectations are worse right now as we speak than they were during the cerveza sickness lockdowns by quite a bit. So at the peak of the cerveza sickness, their bond yields on the 10-year got down to roughly 2.5. Now they're 2.06. So almost 50 basis points lower. Going back to the GFC, their interest rates were 2.7. So now they're almost 70 basis points lower than the depths of the GFC, December of 2008. So the Chinese government, although they might, on one side, be a little more about free market, maybe Schumpeter's creative destruction than the United States, on the other side, they're like, yeah, we're going to allow these things to fail, but we don't want you to know how bad it really is. Why do I say this? Because let's go and look at this article from Reuters. The title here, China's central bank has hundreds of billions of yuan bonds at its disposal to cool the long rally. Why would they do this? See, so what they're doing here, first and foremost, I heard Snyder talk about this the other day as well, where he was talking about how the central bank, the PBOC, came out and was encouraging the local banks to stop buying bonds. Like, stop buying bonds, stop buying bonds. And basically that means not encouraging, that means demanding that they stop buying bonds, or else you're going to the gulag or wherever they send them. So why would they do this? Because they knew that all these banks were buying all these bonds because they're risk off. Because they looked around the economy and like, this thing's tanking. This is going to implode. So we want the risk-free, quote unquote, risk-free asset. We want whatever asset has the most safety and liquidity. And for them, Chinese government bonds. So these banks are telling you, forget what they say to the media there locally, or forget what they report. Just look at what they're actually doing with their balance sheet capacity. And they're sure as hell not lending. What are they doing with that balance sheet capacity? Is they're buying the equivalent of a 10-year treasury. So what does that do? That increases demand, therefore prices go up, yields go down. Well, once the yields go down, then the PBOC comes in and says, whoa, time out. This is a bad look. This is a bad look for our economy. So we demand that you banks stop buying bonds, because if you stop buying bonds, then the yield will go back up to a level that's higher than, let's say, the cerveza sickness. And then the global markets won't know how bad our economy is really doing. And then we can come out and say, oh, yeah, GDP last year, like 4 or 5%. A little bit of a slowdown, didn't it? Didn't meet expectations, but no big deal. But see, what happens is that's a very tough sell to a global market if interest rates on the 10-year are at 2%, are at 70 basis points lower than they were during the GFC. And oh, by the way, now the Chinese bank has threatened to actually short sell bonds. So what they're talking about doing, the PBOC, is going to the banks or their version of like the primary dealers and them saying, hey, we're going to borrow 10-year government bonds to sell into their version of the treasury market in order to make the yields artificially go up so it looks like we're doing okay. So they threatened, I don't know if they've done this, but they threatened to do that the other day. And now what they're threatening to do is, and I think they might have actually started, they're actually selling. I don't know that they're short selling, meaning that they're borrowing the bonds to sell. But I think they might actually be just selling the 10-year bonds, Chinese bonds that they had on their balance sheet to try to bring that yield up, believe it or not. Isn't that ironic, too, that they're going through this crisis mode and they're actually trying to get interest rates up? Because I think what they're trying to do there, at least my base case, would be they want the credit bubble to deflate. They want a balance sheet recession. They want all these things. So they would want higher interest rates because that's going to flush out all, let's just say, the malinvestment and the misallocation of resources to the degree to which they can flush it out in a more centrally planned economy. But they don't want anyone to know this. So what do you do? What do you do? Well, you just go ahead and make the interest rates, the bond curve, look like you're not in a recession. And another thing that was interesting too is their curve isn't inverted, but it's not inverted because, according to my understanding, their central bank didn't do much with rates as far as raising them. And therefore, it's not inverted yet. But again, what we need to focus on more specifically here is what the actual nominal yield is of that 10-year Chinese government bond, because that pretty much tells the whole story when you look at it in relationship to where it was during these other times when they were obviously experiencing, at the very least, a recession. And again, going back to what that looks like right now, currently, and is this up to date? I hope it is. This is trading economics. Let's see if they give us the actual date. So this would be September. I don't know if it's right up to today. This looks like the real time right here. So real time on the right, 2.068, which again, it can't be overstated, is almost 50 basis points, 44 basis points lower than it was during the cerveza sickness. And it's almost, well, it is 70, almost 75. Well, no, I'm sorry. It's almost 70 basis points under where it was during the GFC. That's the main takeaway here. And the yield is that low with the Chinese government manipulating the yield higher. So without the Chinese government manipulating it higher, I mean, you'd see yields most likely sub 2%. So what does that tell you when market yields would be, let's say, 100 basis points less than they were during the cerveza sickness? So I guess the question then becomes, how will this impact, or how could this impact the United States and the global economy? Well, look, it's not like, I understand that China is a net exporter, but it's not like they don't import anything, for heaven's sakes. They import things from the United States. They import things from many, many other countries. They import things from Australia. They import things from Europe. So if their economy is going into the toilet, which we have every reason to believe it is, this is going to, it's definitely going to negatively impact all of these other global economies. The question is simply, to what degree? And then we have to go back to the GFC and realize that this was a United States central event that crippled the global monetary system, because it basically eliminated the mortgage-backed securities from the collateral pool that they were using, and therefore you have this kind of domino effect that you have a liquidity squeeze. So the question becomes, is what's happening in China, could that impact not just their banks, but more importantly, the banks in the global monetary system and the Eurodollar system, to where they would be risk off, pull back liquidity? And if they're pulling back liquidity, then that's absolutely going to have an impact on the banks in the United States. It's going to have an impact on liquidity. And then you have to ask yourself, if you do have that liquidity crunch as a result of something that stems, or as a result of something that springs up in China, if that affects global, how does that not affect liquidity in the United States? And when I'm talking about liquidity, I'm talking about all the derivatives that are so important to propping up asset prices here, such as CLOs, right? Collateralized loan obligations. Those are very, very important. If those go down, then the whole Japanese banking system goes down. If you look at Norinchukin as an example, and if Norinchukin goes down, then that also has a reverse impact on the things that are happening in the local domestic economy. The bottom line here is all these banks' balance sheets are all connected. It's all just a network of bank balance sheets. So even if you have a bank balance sheet that's blowing up in Japan as a result of what's happening in China, that still is going to increase the perceived counterparty risk within the entire system. If that increases the risk, regardless of what the Fed is doing with their balance sheet, that is going to reduce liquidity. And if you have areas of the economy that are dependent upon that liquidity, then that's when you run into issues. So Josh, do you have that chart of their stock market? The Chinese stock market?
Yeah, let me share my screen.
And did you find that metric that's in deflation?
I think it's the PPI, but 1 second, I'm looking for
Go ahead and
this
pull up that
chart.
chart of their stock market. Because the reason I want to highlight this is because
This is the last 5 years.
That's the last 5 years. Okay, so where were they at that high point there? Okay, so how far back does that go?
This is till the early 90s.
Early 90s. Okay, so the point where we are, when was the last time they were at that level?
It would have been 2018.
2018. Okay, so what was the S&P 500 at in 2018? So I'm just trying to, you see where I'm going with this, guys, because one of the arguments here for recession in the United States is that it's just going to be a balance sheet recession. And I think that's a good argument, that we're not going to have 2008, we're going to have 2001. And therefore, there's really nothing to worry about. But my pushback there would be the United States economy is far more dependent upon asset prices now than they were back in 2001. So if you do have that same balance sheet recession, that's going to bleed over into the real economy, to say the least. So do you have the S&P 500 pulled up, Josh?
I'm pulling it up right now. I can just. So in 2018, there were.
Where was the S&P 500?
3,000 points lower.
3,000. So where is it? No, what was the total? Right around where in 2018?
Can you see the chart? It was at like 2,500, and now it's at 5,600.
Okay, so just ask yourself the question, guys. What would happen if the S&P 500 went down by 50%? And then housing in China has gone down by it's probably 50%, but just say that housing goes down in nominal terms in the United States, not by 50, let's just say by 20. Say it goes down by 20 and the S&P 500 goes down by 50%. I mean, just ask yourself the probabilities of that not taking the real economy into recession. I would argue that the probability is incredibly low, because based on what I'm seeing in the United States, the poor and the middle class are not just in recession right now, they're in an economic depression. If you look at the poor and middle class in the United States, I would argue there's very little difference between their life experience right now and what that group would have experienced back in the Great Depression of the 1930s. That's what it looks like to me. Exact, minus the drugs. I would say in the 1930s is actually a little bit better because these people weren't walking around with heroin needles sticking out of their arms, and they weren't so whacked out on drugs that it just looked like a zombie apocalypse everywhere. So the point there is what's propping up the U.S. economy is obviously government deficit spending, but I think for the most part, that's just anti-deflationary. It isn't really just adding to GDP, it's just plugging the hole. So really what's driving demand is the upper, let's say 10%, or said another way, the people with assets. To me, that's what's driving demand in the United States. So you've got the asset class of the people who own assets. They're doing fantastic. Their economy is booming. But everyone else's economy is in the Great Depression of the 1930s. So therefore, if you have that one group that's propping up the economy, if that group experiences a 50% decline in their purchasing power, then what does that do to the entire economy? That's how I would try to think through it. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.